What's up guys, Sean here. This is a sweet episode because I'm just going to be answering your questions about ETFs. If you guys missed them, I made two previous videos about ETFs. One just laying the ground rules of what they are. The second one about index funds, specifically the NASDAQ, S&P, and the Dow Jones. So if you haven't seen those, I would recommend going to check those out. Now, there was also a post I put out on YouTube to get questions from you guys on what you might want answered about ETFs, and I got a couple of good, actually a lot of good questions about those. So we're going to go through those today. We'll be talking about which accounts to put ETFs in, we'll be talking about Canadian hedging, how to find exposure to certain companies, and we'll finish with covered call ETFs. Last thing I gotta say is if you guys are looking for a Canadian broker, I use Questrade. I've got a link, an affiliate link below that will get you $50 free to trade or $10,000 in a Questwealth portfolio managed for free for a year. If you don't already have a Canadian broker and are looking for one, use the link. I get a small kickback for that and it helps the channel out as well. So without further ado, let's get to this. Okay, so I had two people ask me multiple questions on ETFs. The first few we're going to talk about are from Kenneth. So Kenneth, here we go. I'm going to try to answer your questions. First one was about ETFs and which ETFs to put into which specific account, like your TFSA or your RRSP. Kenneth, you also asked another question about any tax implications, and actually choosing which one of those accounts to put them in is really a tax question. So I'm going to kind of answer both of these at the same time. So like stocks, it kind of depends if the ETF is traded on the US stock exchanges or a Canadian stock exchange. A Canadian traded ETF will be taxed differently than the US one. So I'm going to use this analogy just like I would be talking about investing in a US company or a Canadian company. So when you do that, you should know that under your RRSP, the US and Canada have a treaty that says the US will not tax on any capital gains or dividends that are earned in an RRSP. So what that means is you can own like Microsoft or Apple or US company stocks, same thing as US ETFs, inside your RRSP, and those can grow and increase in value, and you won't have to worry about any tax implications. They can grow tax-free in your RRSP. So if you're looking at a certain ETF, but you can only find it on a US stock exchange, you might consider putting it in your RRSP if it meets your investment goals that are the same as your RRSP. And what I mean by that is, like, usually you put money in your RRSP for the long term. Because of course, if you start withdrawing from your RRSP, you have to claim that as income. Similar to that, there's the TFSA. For the TFSA, you could own US stocks. Let's use Apple as an example. If Apple increases in value, you don't get taxed on the capital gains, but you would have to pay a 15% withholding tax on the dividends. So similarly, if you own a US ETF in that account and it pays you dividends, you'll get taxed on those, but it can grow tax-free within that account without you having to worry about tax implications. So you really have to consider the goals that you've set up for your TFSA, the goals for your RRSP, and then what would give you the best tax advantage there. Of course, there's always the third option of owning US stocks and ETFs in a non-tax sheltered account. If you do that, you're going to be subject to capital gains tax based on your income, as well as the withholding taxes for any dividends that those ETFs may pay. So it's definitely worth looking at your RRSP and TFSA accounts, filling those up first before kind of going on to your margin account and paying more in taxes for any gains you make there. Now, the second question from Ken was about how do you figure out if you have certain companies you want to get exposure to, how do you find the ETFs that are related to that company? Which is actually a really good question. So I found a website that you can search for whichever company that you might be interested in. You type it into the search and it will give you ETFs, or at least the top 10 ETFs that are holding that company or are most heavily weighted. I'll showing you an example right here on the screen. If you put in Apple, it will show you what ETFs hold these and in what percentages, and you can kind of go and research the ETFs from there. So that's a really good handy tool to have in your back pocket. By the way, guys, if you're finding this stuff valuable or it's answering some of your questions, please remember to hit that like and subscribe button. It helps the channel get out to more people. And of course, tell your friends about this, have them subscribe. And if you have any more questions, leave them in the comments below. All right, in the last video about ETFs, I mentioned VSP.to, which is a Canadian hedged S&P 500 index fund. Now, I should probably explain in more detail finally what the is Canadian hedged. A lot of the index funds I have mentioned have a Canadian hedged version, and the way that these brokers kind of handle the Canadian hedged version of those indexes, we don't really need to get into the details there, but what you should know is that a Canadian hedged version of an index basically takes out the variable of the Canadian dollar versus the US dollar and how that can affect the performance of your ETF over the long term. It also means that you can probably get that ETF in Canadian dollars, which come tax time is going to be a lot easier for you to understand and deal with. It works just like a Canadian stock. So I'll illustrate this with 3 different ETFs that are offered by Vanguard. These are not the only ETFs that do this. iShares has the equivalent, but I'm just going to illustrate to you the difference between these 3 ETFs, and hopefully this will make sense. Canadian hedging will make sense at the end of this. So first we have VOO, which I mentioned before. This is traded on the US stock exchange. It follows the S&P 500 and it's pretty simple. The only complication here is that as a Canadian, you're going to have to convert your Canadian dollars into US dollars to invest into this ETF. What that inherently means is you're going to have to consider the exchange rate when you convert your Canadian dollars, and you'll probably be paying a fee to the broker or bank who converts your dollars for you into US dollars, unless you use Norbert's Gambit, which is like a way around this whole thing, but let's pretend that you don't for now. So put VOO aside, and now let's talk about the next one, which is VSP. VSP is the Canadian hedged version, which means it's just like buying a Canadian stock. It'll perform exactly the same as the S&P 500, but you don't have to worry about the conversion, and you don't have to worry about the performance of the Canadian dollar against the US dollar and how that might affect your return. It's a lot more straightforward. If the S&P performs 10% that year, then your ETF will also be 10% and off you go. Not a lot of guesswork or variability there. But what if you're an investor that will like to play that variability of the exchange rate in your favor and see if that could work in your favor? Well, you can actually buy VFV, which is also on the Canadian Stock Exchange, but a S&P 500 index fund that takes into account that variability. So now you do have to look at the exchange rate and see how that affects your investments. Now, I had a really hard time trying to figure out a way to explain this simply, but here it goes. I think this example is what cleared it up for me, but purchasing VFV instead of VSP, VFB is essentially a bet that the S&P 500 is going to do well this year and that the American dollar is going to remain strong or won't weaken against the Canadian dollar. If that is the case, VFV will perform well for you. However, if the Canadian dollar starts to gain on the US dollar that year, or however long you hold the investment, it will actually eat away at the return that VFV will give you. Now, if you think the Canadian dollar will weaken, you might want to look at VOO again, because that might be a good investment for you in the long run. But for most of us risk averse, or maybe just those who prefer simplicity, VSP is going to be really good for all of us. Now, Paul wrote me another question about ETFs, about covered call ETFs, which I'll be honest, wasn't very familiar to me, but I did a little bit of research on these, and they're an interesting vehicle to know about as well. Now, covered calls are something that option traders would be really familiar with, and option trading is a little further to the right on the evolution chart for investors that I would say right now, especially for me. But with ETFs, a lot of the complications of options are taken out of the equation, because there is that element of management with ETFs. So something that would be very complicated to do on a single company's stock actually becomes easy to understand when you look at ETFs as baskets of stocks that are kind of passively managed. So here's how these things work. A call option gives the holder the right to buy a stock at some point in the future. Now, it doesn't commit to buying them, but it gives them the option to buy the stock. So during times of volatility in some of these indexes, these options become valuable, and so those holding long-term positions in this index will sell the call options in order to make a profit. That profit tends to smooth out some of the dips in the performance of the index, and over the long term tends to perform a little bit better than just holding the index itself. Now, like I said, normally this is a very complicated strategy to do for a single company, but for indexes, this actually is taken care of inside the ETF, and you as the investor don't really have to worry about it. So a study was done between the years of 1986 and 2011 comparing doing a covered call ETF with just the regular index. What they found is that over time, in this case the S&P 500, did an 807% return over that time period, where the covered call version of the S&P did 830%, simply because during times of uncertainty over that time period, the covered call option was selling those options in order to make a little bit of profit. Now, Paul, you asked what my opinion about these would be, and I definitely think there's something to look into. The only downside is that I feel that they won't perform exactly like the index and might not be as easy to understand or easy to reference as just being able to look up the S&P 500 and say, this is how I did this year. That's a very minor downside that I think isn't really a big deal if you're holding this for the long term.
Sorry, Paul, I did actually find two more disadvantages about covered call ETFs, in that while they are good in falling or kind of faltering markets, they're not so good in markets that tend to rise, because that covered call option trade may actually work against you in rising markets. So because indexes are supposed to rise mostly over time, if it's doing really well and the covered call ETF isn't managed appropriately, it actually could end up eating away at your returns, where you would have been better off just in a regular ETF. The last thing you also got to keep in mind is I'm pretty sure that because of the extra management involved in covered call ETFs, you would also have to pay a little bit more in management fees. So remember to always take that into consideration. It may not be worth the potential extra return on these if your management fees are substantially higher than going with a regular index fund. So that's another thing to probably keep in mind there. So because of this, if it were me, and because I hold the ETFs for the long term and I just really prefer simplicity, that's why I would probably go with just the regular ETF. That's what I do personally. And I probably wouldn't put too much into these covered calls unless I really felt the market was kind of going sideways or volatile, or I wanted to hedge my bets thinking that that was going to happen.
So thanks, Paul, for pointing those out to me. I'm definitely going to look into these, and I'm learning so much more about ETFs through your guys' questions. So if I invest in anything other than VSP going forward, I'll be sure to let you guys know. So keep those questions coming, put them in the comments below. I'll do my best to answer what I can by doing a little bit of research. Thank you so much for the questions, of course, Paul and Kenneth. Until next time, have a great week. Spread the wealth. I'll see you in the next one. Bye.